Good morning.
Good morning.
What was that? Good morning.
Good morning.
I love it. That's what I thought you said. We're very excited. Thank you guys all for being here. I want to introduce the first segment, but I also want to give you an idea of what's going to happen. Ready?
Ready.
Ready?
Ready.
Awesome. All right, so here's what's going to happen. We've got a full morning plan for you guys, and I love the fact that you're here and want to absorb all of this. Our first section today is going to be with our guest speakers. I will introduce them in a moment, but we're going to talk about taxes, what you can claim, what you can't claim, understanding investments. Where should you invest? When you make all your millions, where should you invest it? How should you plan to invest it? And also insurance. We have insurance options for you guys that you should be taking advantage of. As we know, we're all independent contractors in this business. You are running your own business. You need to run it wisely. You need to invest wisely. You need to plan wisely. Our goal, I feel that as a company, while we're in real estate, I feel we're in the business services industry as a company, HomeSmart. We want to bring you all the information you need in order to run your individual business. Okay? So our first segment is going to focus on that. We're going to go through to about 10:15 or so. Want to make sure we get any questions you have, we get answers to it. Then we're going to take a break, about 15 minutes, so you can plan your emails and texts, so you don't have to hide your phone under the desk at the risk of me taking it away from you. If you haven't turned it to silence, please do so now. Okay? If you need to go to the restrooms, for those who don't know, are down around by the elevator. You don't need a hall pass. This is an elementary school. Okay? Just excuse yourself carefully, okay, and quietly. Please realize we are taping this session. So if you ask a question, just speak up. Our speakers also know we have the machine in the back just to cool things down. So, if you ever need something repeated, just ask us as well. You are not in the video. Only the speakers are in the video. But if you talk and whisper amongst yourself, I will turn the camera on you. That's the easiest way to get people not to talk. Nobody wants to be on film. Well, some people do. Rob's like, oh, I'm ready to talk. Can I whisper to you, Ty? Because I want to be on film. Okay, so we're excited. We want to start live streaming our education. There are times that people just cannot make it to class. Right now we're starting with taping, and so that we're going to create a YouTube channel so that everybody has access to it. There are times you can't make it. Watching something on a video is not the same as being live and being interactive and answering questions and asking questions, but we also realize that people just sometimes can't make it. So we're trying to make that available to everybody. So we're excited about that. That's our new thing going into the new year, is creating a library for you guys. And you can, if there's something you missed, you can watch it again as well. Okay? So, second half is going to be goal setting. It's going to be very interactive. We have a program that allows you to go in with an Excel format to plan what you want to accomplish for your business based on your income goals, and how you need to break down your accountability for yourself to the tasks that will allow you to get there. Okay? So we're going to go through to about 12:30 today as planned. We're mindful of your time, and we want to be mindful of the timing for the segments as well. Okay? Thoughts? Questions? Ready to go?
Ready.
Excellent. So with that, I want to introduce our guest speakers this morning. Please come in. Come on. Don't be shy. Absolutely. Folks, so I want to introduce Jeff Wadovic, who's from NATO Wadovic Accounting Firm in West Warwick on the East Greenwich line. Margie Hernandez is with Aflac Insurance. Some of you may have met Margie in the past at a business meeting or here in the office, because she's working with a lot of our agents, and she'll talk about the program that she has. And Tommy Vigil, who's with Providence Financial Management. I've been practicing that title. That's why he's watching me carefully. So we thank you for being here. Thank you very much. Okay. So I'd like to start, though, by making sure that everyone here knows each other, but at the same time, our guests get a sense of the audience. So if I may, quickly, we're going to go around the room, introduce yourself, tell us who you are, and tell us how long you've been in real estate. You can also add how long you've been at HomeSmart, because we love hearing it, okay? Because all of us had a former life, okay? But I also think that everyone needs to know each other, everyone needs to be networking, and you need to create relationships within the company as well. Make sense? Okay? So we're going to start in the back of the room.
Good morning, Peter Izzy of the Peter Izzy team. Been in real estate for 13 years, and I've been with HomeSmart for almost 3.
Great, thanks.
Good morning, Corey Dimmeline, also with the Peter Izzy team. Part-time agent for 2 years in Kentucky, and full-time agent here for about 3 months for Peter's team. And
Awesome. Great.
Evelyn Renone. I've been in real estate since 1998. You can do the calculation. I've been with HomeSmart since October. I do real estate part-time, mostly referrals, because I work with a mortgage company.
Great, thanks.
Karen Bouchard, 7 months real estate agent, 7 months with HomeSmart.
Awesome, great.
Jeannie Gorey, I've been an agent for 20 years, and I've been with HomeSmart, my smart move since March.
Awesome.
Lisa Gibbs, been an agent for 1.5 years, and I've been with HomeSmart for 10 months.
Great.
Chris Petrus, been with HomeSmart since over 2 years now, real estate since 2009.
Mark Bevo, 16 years in real estate, been here at HomeSmart since it started.
Great.
Fred Burnett, 41 years in real estate and 4 months here. And I
Awesome.
tend to do more commercial.
Yep. If everyone needs help with commercial, Fred's focus is
Yeah, good to
commercial.
know.
That's good to know, absolutely.
Absolutely.
Ramona Cummings, I've been in the industry since '92, but I've been a realtor and an agent with HomeSmart for 2 years.
Great.
Leslie Paradise, I've been an agent around 18 years, and I've been here about 6 months.
Awesome.
I'm Mary Shawcross, I've been an agent for about 2 years, and I joined HomeSmart in May of this year.
Awesome.
Trisha Morency, been an agent for 4 months, and I've been here for 4 months.
Right out the gate.
Right out the
That's
gate.
right.
I'm Joan James. I am a brand new agent, and I've been with HomeSmart a minute.
A minute. But you're not a brand new agent.
So I did real estate back when Dean was brand new, and that was
For
fun.
10 years?
So, yeah, 10 years.
Eight to 10 years?
I was about 7 years.
About 7 years in real estate in her past life.
In my
She's-
past life.
She's just coming back to it, so
Yes.
we don't want to lose sight of that experience. Absolutely. Ty.
I am Ty Cordero. I've been with HomeSmart and a realtor for about 8 months now.
Awesome.
I'm Rob Scungio. I have been a realtor for about 2.5 years, and I started my career with HomeSmart.
Awesome.
Karen Morrow, realtor for 13 years, 8 months, HomeSmart.
Great.
Samantha Durand, I've been in real estate for 3 years and with HomeSmart for 2.
Awesome. Great. Now you all have a name to go with the face, so make sure you get to know each other at the break, and anybody you haven't met, take the chance to do that. But again, it also gives us a sense of the direction of the conversation to make sure we're bringing information that's pertinent to you, because regardless of your level of experience in real estate, the time you've been in real estate, you need this information, whether it's now or in the very near future. Because ultimately, our goal as a company is to help you reach yours. So whatever that looks like, you need to let us know. And this is just the start of that. Okay? Great. So with that, I would love for you guys to take it away. Jeff, would you lead the way?
Sure.
We're going to be mindful of everyone's schedule this morning as well. So Jeff is going to get our conversation started, and he's got to excuse himself because an emergency came up, but he wasn't going to let us down. So we appreciate that, and we're going to be mindful of your time. So get out of your way. I love that. That was really well done. Get out. My turn.
My name is Jeff Wadovic. I'm a CPA and I'm a partner with Nato Wadovic. I've been practicing for over 25 years here in Rhode Island. And I apologize, I do have to scoot out. I do have some other things going on today. It's the time of year where everybody wants a little piece of me to figure out whether they owe any money. So, but I appreciate Dean going through things because I made notes, okay? So we have four participants today, if I'm correct. Karen, Gina, Trish, and Ty, that are all basically new to real estate, right? Mm-hmm. Brand new? Okay, so your accounting is going to be a learning curve compared to Frank, right? It's Frank? Fred, sorry, Fred, who's got 41 years. So Fred pretty much probably has it down like the back of his hand on what he needs to do. He does a Schedule C and knows exactly what to report. So I'm going to try to spend a little bit of time on the newbies, I call them, with some basic information that you guys need to think about. And I would think about them, but at the same point in time, if you don't make any money, everything I tell you won't matter because you need to make money first. And then the rest of you guys that have some experience will just touch base on some basic items. So, and then, Peter, are you the only one that has a team here?
Yes.
Okay. And how many people do you have on your team?
6.
Okay. So, because Peter can handle things perhaps a little bit differently than the rest of you, because he actually has so-called agents or employees working underneath him. So he may have some different options that may not be available to you guys as an individual, because he think of it as an employer. He shares in some of the income that's earned by his agents that work on his team, and he has some group expenses that may apply to the entire team. So his treatment of taxes may be slightly different. But just to start off from the basics, everyone here pretty much prepares what's called a Schedule C. Does everybody know what a Schedule C is? I know most of you guys do. Schedule C is a tax return, or excuse me, a form within your personal tax return that reports your income and loss from being self-employed. So what you're going to get at the end of the year is you're going to get a 1099 from HomeSmart that says X, all right? And then you're going to, below that, you're going to fill out all of your expenditures on the form. Does anybody prepare anything other than a Schedule C right now? Okay, so everybody's pretty much straight on. You may have some other options, but we can explore that in a different time. But okay, so you take the Schedule C, it's on your personal tax return, you put your income in and all your expenses in, okay? So expenses, expenses can vary. So many of you guys who have been around for a long time understand some of those expenses. Obviously, the expenses associated with anything that you do to promote the sale of the house, if you are on the seller side, okay, any of your listing costs, anything associated with that, any of your office expenses, desk fees, if you pay a desk fee, equipment, and we're going to come back to that because equipment may be capitalized depending on what it is, computers, printers, fax machines, business gifts, communication costs, okay, so cell phones, stuff like that. We're going to come back to a home office because you may be entitled to a home office deduction, and I'm going to come back to auto costs, okay? So what you do is you accumulate all those expenses. I recommend that you, especially for the new people, consider having a separate bank account for your activity so that it's easy to track. I like to set things up separately because in 3 years from now when I'm asked a question, I can't remember. So if I have it in a separate bank account or separate account, I go, oh yeah, here it is. This check, this, whatever, okay? Usually what you do is you take some money and you fund the bank account. Okay, that's considered capital going in, that's not income, all right? And then every time you take money out of that bank account personally, that's not an expense, that's just repaying yourself back. Any of you guys that have been doing this for a while, do any of you have separate bank accounts right now? Okay, so can I have those hands a little higher? Okay, so the new people, find one of them and ask them how it works, because they have the system down, okay? It's very easy to track, okay? I recommend this. Work pretty good?
Yes.
Okay, so, and
Jeff, may I interject? Just for those who may not have separate accounts or who need to separate things, we do have benefits associated with our banking relationship with Washington Trust. You get $100 for opening a checking account, which is where we're going to be doing automatic deposit for your commission checks starting the beginning of the year. So, just if you're looking to do that, there are some benefits, so just see NIVIA for the details.
so some other costs that are eligible are advertising, again, if you're marketing a house or your websites, mailings, anything like that. Bookkeeping, legal fees, if you have any legal fees associated with it. Meals and entertainment. Meals and entertainment are 50% deductible. So if you come to me, you're taking me out and you're buying me dinner, because I'm looking at buying a house, and you spend $100, you can't deduct all 100. You can only deduct half of it. You put all 100 of it on your tax return, and 50% is what ends up being deducted. Those of you that have been doing it probably know those rules. Okay, so let's talk about equipment. So equipment, computers, things like that. You've got a computer up front here. So the computer here is deductible. In theory or in practice, it's deductible over time. Okay, so the idea is that that computer may be good for 3 years. So if you spend $900 for the computer, then you can deduct $300 per year. Now, if you have a profit, you may be entitled to deduct the computer in its entirety in year 1. And that's called Section 179 property, and your accountant will know what to do with that. But it's not, the computers or any hard equipment is not considered like a soft cost, like office supplies, paper, things like that. So anything, printers, any technology equipment that you have would be expended over time. Now, automobiles. So automobiles, there's a couple different ways to handle automobiles. So you can handle automobiles by taking the IRS mileage allowance. Does any of you guys take the IRS mileage allowance? Okay, so some of you know what that is. Or you can take direct expenses. Okay, so those of you who take the mileage allowance know how it works. You keep track of what mileage you drive. Okay, and you're supposed to have a contemporaneous log. Anybody have you have a contemporaneous log?
Yeah.
Oh.
I just use an app.
Oh, that's perfect. Very good. She's very good. Because she's a woman, okay? Because I just use my calendar. I can't keep track of the app. But no, the apps I've heard are very good. You get in your car, and there are several of them out there. You hit the app, and then it tracks what you've done. So then you take that cumulative mileage times whatever the IRS amount is for that year. I think it's 51 cents, or it was 54 cents, something like that. And that's your deduction, okay? And you get to take the greater of that deduction or your actual expenses, okay? So your actual expenses, what I would encourage you to do is keep track of your actual expenses, perhaps in your personal checkbook or the business checkbook. Pay for everything. And when I say everything, you pay for gas, you pay for insurance, you pay for repair and maintenance, everything. Now, you can't deduct 100% of it, because I'm sure you use your car to stop at the grocery store, right? So that's not deductible. And your trip from your house to here is not deductible, okay, because that's considered commuting. But if you go from here to a showing, and then from the showing home, the trip from here to the showing is deductible, but from the showing to home is not deductible. That's the technical rule, okay? But, so what we typically do is, if you are eligible to take the greater of the mileage deduction or the actual deduction. And the actual deduction is something less than 100%, let's say 80%, and then you can compare the two. I would recommend keeping track of what your actual costs are to determine whether it's which one is more beneficial. And you can do it at any, you can switch back and forth from year to year. So this year you may take the mileage, next year you may take actuals because you got a lot of repair and maintenance on your car. Things that aren't deductible. When you buy the vehicle, payment of the vehicle is not deductible. Okay? You can't, if I have a loan payment of $500, I can't deduct that. Okay? It's just real expenses. If you have a lease, a portion of the lease payment may be deductible under this scenario on the direct expense side. Okay? It may be deductible. You have to take a look at the lease. There's some technical terms in there as far as what can be deducted and what can't be deducted. Everybody understand?
What are you looking for in wording in that? For a lease?
I'd have to look at the research and figure out the lease. There's a percentage of the lease can be deductible, and you have to look at your business purposes and so forth as to what percentage can be deducted.
Okay.
So, home office deduction. Oh, sorry.
So if you buy a car, you can't deduct it. So I did that one this year.
No, you can't.
So probably better mileage then, yeah.
Well, if it's a new, what I find is if the cars are newer, mileage works the best because your gas isn't going to exceed the mileage. The mileage allowance, at 50 cents per mile or 54 cents, I forget, that is always changing. That basically encompasses everything associated with the car, your repair, maintenance, depreciation, everything. Where the direct method would be whatever expenses you incurred. And if you have a new car or a 2-year-old car, you probably aren't replacing tires, you're not replacing brakes.
Right.
Okay?
Yeah, thank you.
So, home office deduction. Okay, so many of you would be entitled, I would assume, to a home office deduction. Anybody understand what a home office deduction is? Okay, so a home office deduction is you get to take a portion of your home, if you have a dedicated space in your house, and write off the expenses associated with that. So, what are the expenses associated with that? It's pretty much everything associated with your home. So it would be all your utilities, your cable, certain repair and maintenance items, and real estate taxes, although real estate taxes are deductible elsewhere. Interest on your mortgage would be deductible, portion of it. So how it works is that if you have a home, and I'm just going to use simple math, let's say it's 1,000 square feet, and you have one dedicated room, supposedly it's supposed to be dedicated, and it's 200 square feet, what is that, 20%, right? So you're eligible to take 20% of everything. Okay? You could take 20% of, you could depreciate your home. So if your house is, you bought it for $100,000, you could say 20% of it is dedicated, so I can depreciate $20,000 worth of the home. But you have to be very careful with that, because if the home appreciates in value, and everybody knows, because you guys are all in real estate, you have a capital gain, right? And what happens with residential capital gains, if I live in my house? What's that? You don't pay any tax on it. $500,000 exclusion. So if I buy a house for $100,000 and I sell it for $400,000, I have a $300,000 gain. And I lived in it the last 2 out of the last 5 years. I don't have to claim any gain. Anything over 500, assuming I'm married, anything over 500 is taxable. But as soon as you depreciate part of your house for business purposes, that segment becomes a business asset. And if you have a $300,000 gain, and 20% of it you've been depreciating, now all of a sudden you have a $60,000 capital gain, and you do pay tax on that. So you want to be very cautious. I don't think I have any clients that take a home office deduction that's depreciating their house. I had one client that did it, and his house escalated, and he had a $100,000 gain on the capital piece, and he was really aggravated. But because he got greedy on $20,000, he ended up paying capital gains on $100,000. So what I would do again on that situation, on your home office stuff, I'd keep track of all of your expenses. I wouldn't pay for the home office expenses through your checking account, through your business checking account, but I would just keep track of it, keep a list of it. There is also a way on your Schedule C to do the simplified method of your home office deduction. And I'm not going to go through the detail of the calculation, but it comes up with a very simple number. Yes, sir.
If you did not take that depreciation, but wrote off 20% for the other expenses, you have to somehow recover that and pay taxes later on with other things?
No.
So it's just depreciation?
Just depreciation, yeah. I mean, if you don't take it, you lose it,
Right.
okay? But the issue is that, hold on one second, the issue is that I did have a client several years ago that had a $500,000 gain in his personal property. And he did exactly what I said. He bought the house for $100,000, and he wrote off, he came to me after he had started this process. He wrote off $20,000 as personal use of his home, as his home office deduction. And when he sold the house for $500,000, we had to segregate the gain. $400,000 was personal and tax-free, and $100,000 was considered a capital gain, and he ended up paying about $25,000 in taxes, when that $100,000 could have been under the exclusion. So you just want to be careful that you don't get too greedy, try to claim a deduction today, and then in the long run end up having a capital gain. Okay, you got a question?
At one point, I know you had to have separate entrance into your home office.
Sure.
Was
No,
that
you
still
never,
the case?
no, you never really need to have separate entrance, no. You just really cannot have it, like, for example, I'm an accountant, I have an office, okay? I can't take a home office deduction, because I have a physical office I go to. You guys don't have a physical office here. I mean, you really have just shared desk space. So you come to the office here, and, you know, Fred could be sitting on one desk one day and another desk the other day. It doesn't have anything personal there, so that's why you would be entitled to a home office deduction. And where do you pay all your bills? Where do you do your marketing? You might do some of it here, but you're probably not paying your business expenses here. You might probably sit at home and say, okay, I gotta do this, I gotta do this, so. Okay? Let's see.
So like utilities, internet, all that stuff that you would pay for your home office, just do it through a separate account, and then at the end of the year, say I did this much in utilities?
Correct.
Okay.
Yeah, I would just keep track of it on a spreadsheet or something like that.
Okay.
Cell phone, I pay through your business.
That's what I did.
Anything that's associated directly with the house, I would keep separate.
Okay.
Now, I said some repair and maintenance. If you reside the entire house, I wouldn't take 20% of that. But if you put some new carpeting in that room, or did some painting or something like that, that's associated with that room, you would be eligible for that,
Okay.
for a portion of that.
It has to be an actual room though, it can't be a corner of an existing room.
I mean, the rule is it has to be a dedicated space. I know in today's world, we all don't have necessarily dedicated spaces. Many of us have a corner of the room. And I think the issue is, you know the difference between a hog and a pig, right? The hog gets slaughtered, okay, and the pig lives to see another day. So I think as long as you're reasonable, okay, about what you claim, I think you're okay. Remember, the deduction, if you, a lot of people I see home office deductions, the total cost is, let's say, $3,000 for the year, okay? Does anybody know how much that tax savings actually is? Tax savings is only about $700. Okay, the IRS isn't looking for $700, they're looking for $7,000 or $70,000. So, you know, I'm just trying to point out little bits and pieces where you may be eligible for some expenses. It's clearly not going to be the largest deduction that you have on your tax return. Okay? Okay, a couple other things. So everybody's a Schedule C, so for the most part, does anybody know what an LLC is?
Limited liability company.
Who has a limited liability? You have a limited liability company.
I have one with the real estate that owns.
Okay, so your limited liability company is a disregarded entity though.
Is it what?
How many members are in the LLC? Okay, so she has what's called a disregarded entity, okay? So an LLC is a limited liability company, okay? Limited liability company. You form it with the Secretary of State, all right? It has no tax savings, 0 tax savings, okay? So you're Samantha.
Yes.
So Samantha has an LLC, and the LLC is formed basically to protect her personal assets. I'm not an attorney, but the basic format is that if you conduct all your business through your LLC, she forms an LLC with the state of Rhode Island. She opens up a bank account, okay, in the name of Samantha LLC, and she conducts all of her business under that umbrella, okay? When Samantha has a problem, okay, she's gross negligent on something, not saying you are, but her $10 million house in Narragansett next to Tom Brady, which is kind of nice, right?
Sounds wonderful, keep going.
Isn't subject to liability claims, okay? So that's why you would set up an LLC. So the question is, should you be an LLC or shouldn't you be an LLC? You really need to speak to someone legally on that. It has no tax savings. The only tax savings that could be there is that if Samantha and I were partners together, okay, we would be a partnership, and there could be some tax savings there. But most of you won't have partners, except for Peter in the back, who well, I actually should say Peter in the back doesn't have partners, but he has staff people below him, so there could be some savings because I'm sorry, what's your name again?
Corey.
So Corey works, okay, and Peter earns a portion of a profit off of him. So that profit right now, if he's considered a self-employed, he pays self-employment tax on Corey's profit. So he could set up a separate entity that could shield some self-employment tax that's earned on Corey's profit.
Okay.
Yes, Fred?
Do you know how much it costs to set up an LLC, and do you have to pay like taxes on it?
Okay, great question. So if you do decide to go, you know that, Samantha?
Yeah.
Okay,
Yeah.
so if you do set up an LLC, all right, there is an annual filing fee. The annual filing fee is $50 a year, okay? And there is an annual tax, a flat tax, and it doesn't matter whether you make $10 million or you lose $10 million. The state of Rhode Island flat tax used to be $500. In 2017, it's come down to $400, okay? So those are the two fixed costs that you have. As far as setting up the LLC, you can actually walk into the Secretary of State and do it yourself, okay? And it's $150. And if you can do it online, and they charge you a $6 filing fee, or processing fee, so it's $156, but it's very, very simple to set up. But if you do set it up, to protect your interests, you have to run it like a separate entity. So you'd have to have a separate bank account. Don't put your dry cleaning through there. Don't put your groceries through the bank account. Write a check, $1,000, transfer it to your personal account, and then pay all your personal bills. That's one way to pierce the corporate veil and come after your house next to Tom Brady. Okay. Is it nice?
It's very nice.
Okay. So, my personal opinion for you guys, especially you newbies, make money first. If you don't make any money, you're just wasting time on other things, okay? Those of you that have been in place and you're concerned, you may want to consult some legal advice. But again, if you set up a single member LLC, it will have no tax savings, okay? You'll only be, there'll only be money going out, and the reason why you want to set it up is to protect your personal interest, or basically shelter that and put it in a bucket that's by itself, okay? Sometimes people do it because they have multiple things, like Samantha may be a real estate agent, but also own rental property on the side, and so she separates the two entities, okay?
Excuse me, would it be wise if you had 3 rental properties to almost have separate LLCs?
Do you mind repeating that question, Fred?
Yeah, the question was, if you have rental property, 3 rental properties, should you have 3 separate LLCs? Fred, I don't think it's necessary to have 3 separate entities for each LLC. I would recommend if you have more than 1 rental property, you probably should set up an entity and put those properties in the LLC. Those are a little bit different than what you're basically brokering real estate, because if Fred owns a home in Cranston that he rents out and somebody slips and falls, that's completely different than you guys as an agent, I think. Now, there's other ways to mitigate the risk, because you can work with a real estate agent and get an umbrella policy. And if you don't have an umbrella policy, you probably should have an umbrella policy. An umbrella policy basically covers you in the event that there's no other insurance to cover you, and they're relatively inexpensive, a few $100s, depending on the limit that you get. Okay, and that's probably something that you should have as an umbrella policy. Okay, the last thing I want to touch base on, which Tom's going to come in and talk about, is retirements. Okay, so as a sole proprietor, okay, as an agent, any of you putting money away in retirement? And Samantha's right here. That's why she has that house next to Tom Brady. Okay, so there's a couple different options to put money away. You have an IRA, okay, which is, again, will defer taxes. You have what's called a SEP, okay, a Simplified Employee Pension Plan, okay, which may be the maximum amount. You could put away almost 25%. So if you make $100,000, you can put $25,000 away, and that has a direct tax savings. Or a simple, or a 401k, simple 401k,
Yeah,
right?
you can actually do an individual 401k, which would give you a larger contribution than an IRA would.
Now, the issue becomes, I just said the SEP, if you make $100,000, your net income on your Schedule C is $100,000, you can defer $25,000, roughly, a little less, but roughly, it's 25%, but there's a circular calculation. They never make it easy. So, but let's just use $25,000. So $25,000 may save you $7,000 in taxes, right? So you don't want to pay $7,000 in taxes. But the problem is, you got to put $25,000 away. So, right, so you save $7,000, but you got to put $25,000 away. So in essence, you really got to come up with $18,000 of additional cash. So everything has a double-edged sword, and every pension plan has a double-edged sword. Some of you may make more than $100,000, so therefore the IRA is not good, because you're going to be disqualified. There are Roth IRAs, which Tom's going to talk to you about, which is all post-tax dollars. Does everybody understand what that means? So you take the money after you pay your income tax, and you put $5,000 away in a Roth IRA, and it accumulates earnings, okay, so, for the next 40 years, and then you take it out as tax-free. So, but again, that's after